Hello and welcome to the Harwood Report for January 8th, 2018. I am your host, Keith Harwood, the founder of Trade Academy. So let's get started with the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Remember that all of this is the way that I am looking at the markets. These are not considered trade recommendations. Options have risk. Consult your financial professional before executing any trade. I always put this page up there. I'm going to look at the equity indices. There's some interesting stuff starting to happen, I think, with sector rotation. Qs have been really strong. IWM's been flat. SPY has been pretty strong, obviously. Really good start to the year in equities. There's going to be some trades around that because of where volatility is, more so than maybe where I can see a clear picture for the next leg of the market. But I'll get into that here as I go through. Bonds, TLT, maybe starting to create a little bit of clarity on the next direction, but right now it's still pretty choppy. Gold, this one's much clearer to me now. It's been a little bit of a battle there for the last few weeks, if not longer, but I think this is starting to finally get some clarity. And oil, of course, is just continuing higher, and that's pulling XLE and OAH higher. So I'll talk through where, how I'm looking to trade those markets as I get in here. First things first, fear and greed, 74. We're getting close. I get worried above 80. Above 80, it tends to top out. That said, above 80 doesn't mean that the market pulls back. It just means consolidation. That changes the way to trade the options in this stuff, because if I'm long outright options and the market sits, I actually lose money. I need to look for different nuance type stuff. There are places right now to go with long outright options. I'm not sure it's in the overall equity market. So let me dive right into that. First things first, we've got the S&P 500. New all-time highs every day. Previous high was 56, today's high is 61. So we now have another day with a new all-time high. That said, it's a much smaller move, relatively speaking, to the prior days. So we have big money flow, big money flow, big money flow. 3 consecutive days of big moves followed by a day of sort of stagnation. I would expect here this to kind of follow suit with what I've talked about before. We've gotten ahead of ourselves a little bit. These moving averages need to play some catch-up. That's how we get a little bit of chop and maybe even lower price action. Looking for maybe a move back all the way down to 272 into the end of this week. That's not a huge move. There's not much I can play that with. Even on a breakout, I'm not that excited to play this because options aren't actually all that cheap. We're getting into earnings season. So until I see options get cheaper on the whole, I don't really want to play anything major in SPY. SPY will be a little more nuanced trade that I'll highlight in the newsletter, the premium newsletter product that'll go out a little bit later today. It's not an explosive return profile for me, but it has a very good R&R. IWM, this is more interesting to me. Look at all this consolidation. Look at all this chop. At some point, this has to take a move. If the dollar starts to weaken, if the dollar's strengthening, if bond yields start to confirm, financials should get a bid. That could help this breakout happen. If we look at KRE, that's the regional banking. It looks a lot like IWM right now. That's pretty flat here, and it's been chopping along with TLT, which has been chopping, but you see TLT is a little weak today. So that's really the driver for me in IWM. This weakness in TLT, if that continues, that should put some money flow into financials and money flow into IWM. So on a move above the high of 155.15, I'm looking to get longer here. Remember, this 155.41 was before the index went ex-dividend. So 155.15 is the high. And for me to play that, I can see here that in IWM, volatility is fairly cheap relative to recent history. 10.3% is about as low as it gets. 11.5 is a really good level. And if I go out to January 26th, I can get vol around 11.5 and a little lower on the upside. So what I'm thinking here is that on a move above 155.15, I want to look towards buying some of these 156.5 calls. 7.5 may be a natural stopping point, so 56.5s, around 85-ish cents, maybe the 90-cent level, because I think vol will get hit into that rally. Give me a really good leverage for a move to 157.5 and maybe even further. Remember, IWM versus the Qs is trading basically at its lows. So Qs have traded traditionally anywhere between about $4 under IWM all the way up to about $8.50 over. And right now it's $8 over IWM. And it makes me think that this rotation, the next rotation, kind of has to be into these small caps, especially if TLT fades. So with that, Jan 26, 156.5 calls. They're 74 cents right now, but I will be looking to enter these once IWM truly firms and so gets above 155.15. Back to the charts there. I mentioned the Qs. Qs have had an insane run here. They're actually stronger than the S&P today, stronger than everything really today. They are the leader still. There's some money going into SMH, and that's been my main, sort of subsector to watch in the Qs and in tech for looking for a rally here. And notice that this big break in SMH has now been completely unwound. So we've set here at 104. This looks like it's got to move to 105, maybe even up to 106 and a quarter-ish range, make a new all-time high. But for that, I think it has to be subsector rotation. And we're seeing that a little bit because we can see the biotechs coming down today. So another subsector of tech is getting hit while money flow is going back into the semiconductors. So for me, this is more of a subsector rotation game in the Qs, especially with how high Qs have gotten relative to the moving averages and IWM. So I'm not particularly bullish on the Qs. It's, again, a very nuanced trade that I'll highlight out in the newsletter. Qs have some really good R&R trades. They're just not, for me, on a big outright long option play. I mentioned TLT before, and I want to come back to that. Oh, sorry, one more, Dow Jones. I've been saying it for a while now. Dow Jones just looks like the S&P. I don't want to do anything. The markets are wider in Dow Jones, so there's no value for me in executing a trade there until it starts to really separate itself from the S&Ps. Now, TLT. The key level for me to watch here is basically this 125.07 low from, what day is this, on January 2nd. So that's the low of the year, quote unquote, we're a weekend. But really what that sort of sets up to me is that peak below the 200-day moving average again, and then this becomes the support. So that means that now we're starting to get a little more clarity to me. I think we're going to test this 124 level, and that's how I want to trade it for myself, is for a play as a test on 124. And then the market will have to decide whether it wants to push through 124 down here to the 122 level, or if it's going to hold there. 122 and roughly right here, 122.40 is going to be a big level because we see that's held there and there. So it's held twice there. 124 is my intermediate target for how I'm going to trade this, and that's going to give me a look here at where vol is. Not cheap. But I can do something a little nuanced here because January 26th options are cheap. So if I move to 124, I can do something a little more complicated and just do a calendar. Buy the January 26th 124 call puts, and sell the January 12th 124 puts. It's a very simple trade. It's 34 cents mid-market. That's a good way for me to play a move down to 124 and then a decision point. So if we continue to grind lower this week, this sets up really well. Where I'd been looking in the past was on a 125 calendar on a no direction kind of move, but with the market starting to firm up that much more, I think that TLT kind of has to break, and that's the way I want to play it. May end up rallying out of this, but I'm thinking right now for me, the play is on the bear side where I can buy some January 26th 124 puts at 9.3 vol and sell the January 12th 124 puts at 11.7 vol. It just gives me a really good vol spread for a slightly weak board this week. Let's go into the metals from this because the metals are the big play for me right now. Dollar yen really looked good last week because the market was good last week, and it's continuing to hold here above all the key moving averages. Double top here. I'm not sure that's going to hold unless the market really falls out of bed. This doesn't look like it's going to hold. Dollar yen looks like a move towards 114.5, maybe even higher. And in that play, GLD should get weak, and it's starting to weaken today, but it's still sort of in a consolidation mode here. So GLD looks a little weak, not terrible yet. But let's look at those miners. They had gotten ahead of gold on the way up, and they are the first to break. Below the 10-day moving average for GDX, below the 10-day moving average for GDXJ. GDXJ looks the weakest right now on this. It's the first breaker. And SLV, of course, looks a little bit weaker, but not as weak as gold. That's still above the other moving averages. Silver had a little bit more catching up to do from the short-term moving averages. So for me, again, this is all about where I can get the cheapest vol in the space. I'm bearish because it looks like dollar yen's going to hold, and it looks like it's going to continue to firm. So where can I get that cheapest vol? Well, I'll go through them one at a time. GLD vol, it's sort of cheap at 10%. SLV vol is a little cheaper at 16.5%. That's near the lows. I like that. GDX vol is close to the lows here from 19%, so I like that. And GDXJ vol is pretty close to lows here at 24%, so I like that. But what I do note here is that while this is 25% here, the front end is 22%. So I actually bought some puts today. I went to the January 22nd, 33 puts. I paid 34. At the time, prices were a little lower, so it was around a 23%. And I like that as a way to express this view, because with 23% vol, I don't get hurt badly. Realized vol has been a little lower, around 22.5%, so I've got a pretty good, safe way to play the short without having to have just an outright naked short. So I've got my defined risk, I've got a little bit of leverage, and if this break happens in GDXJ, we could easily see levels back into the low 31s, 31.5, maybe even lower. So a 33 put with 2 weeks to expiration has a lot of leverage for me at 34 cents. So that's my way I'm playing the gold right now. So I'm doing it with the miners because the miners really rallied the most and I think have the most downside. I mean, at a minimum, I think we have to get back to this consolidation area if gold continues to be weak and dollar yen continues to be firm. So that's how I want to play that. All right, finally, let's go into oil. Oil itself looks like it's doing a little bit of consolidation. Every time we get way above these moving averages, we got to let them catch up a little bit. They've all got a really nice slope here to the upside, though. All these moving averages are starting to catch up. This is just generally a bullish market. We're above all these recent highs until we get a break back below the high from here, $12, which was the high in January of 2017, so a year ago. I don't think I want to play anything on the short side in oil or in oil companies. And so XLE continues to consolidate here at the top. I think this is going to happen for a little longer, though. 75 is a really good natural stopping point because the market does love even numbers. Could take the rest of this week. Maybe by the middle of the week, I'll get a little bit more clarity on this, especially as we get the oil data to Tuesday afternoon and Wednesday morning. That might give me a little bit more excitement for the upside. But unless I start seeing another breakout here, I can't get too excited about XLE. OIH is the more exciting sector, and it has been for me for a while. I did exit all my OIH last week. Just this move up towards 27.5 looked like it was getting a little ahead of itself from the moving average perspective again. But I may be looking to get back in above 28 because that kind of sets up that move towards 30.5, 31. The other thing I have to keep an eye on always with oil is the vol level. So I know that for my options positions here, XLE vol is fair value-ish, not cheap, not expensive. OIH vol has come up quite a bit. It's up over 25% now. So for me to get in, I need to see either vol come down or see more momentum picking up. Because historical volatility is still under 21%. So if I can get that vol to come down here, and I can start buying vol again at around 23% while we test the highs, then I can look at some of these 29s for January 26th. But for now, this is a different nuanced. Maybe it's a calendar play. Maybe it's going to be a butterfly. I'm not sure yet. I'm going to work through a few different structures to put out in the premium newsletter on that. And speaking of the premium newsletter, as a reminder, the premium newsletter Harwood Report is basically an extended version of what we've done today. I talk through in the newsletter the trade ideas I've got for each of the equity indices, as well as each of these commodity indices that ETFs I've been talking about. I also do another video on Wednesdays giving a midweek update because markets don't change once a week. They change consistently, obviously. I talk through a little bit of why I'm picking some of those structures when I go through that stuff as well. And importantly, if you want to try it out, first month's free. After that, it's $49 a month. So if you like it, if it's giving you some value, if you're learning something, which is the goal, stay on. If not, it didn't cost you anything to try it out for a month. So I urge you all to try it out. Go to tradeacademy.co/Harwood Report to sign up. And finally, contact me. You've got the website, tradeacademy.co. Email me, keith@tradeacademy.co. Pick up the phone. Call me 312-600-8004 with questions or comments. And always follow me on Twitter @TradeAcademyCo. Thanks a lot, everybody, and have a wonderful rest of your afternoon.